Well, good afternoon, or good morning, or even good evening. Thank you for joining this session. My name is James Holly, and I'm delighted to be moderating this fantastic panel of ESG experts today. I'm head of ESG at Bridgepoint, a recently listed international alternative asset fund management group, focused on investing in the middle market. And today's session personally resonates with me. The EU Sustainable Finance Disclosure Regulation, or in short, SFDR, has been implemented to enhance ESG disclosure across the financial sector. And on the face of it, I think it's a great opportunity to improve the overall transparency on ESG performance across the sector and beyond. But in reality, I think trying to understand it and apply it is certainly not easy. And we've had legal advisors and have pulled together an internal SFDR working group for much of this year to try and get our heads around it. And it's certainly been a very challenging piece of regulation to navigate. So hopefully this session will bring some of those challenges and the practical solutions that are available to the table, and certainly hear from our panelists on that. And without further ado, less about me and moving on to our panel, I would like to introduce, first of all, Dan Bottrell. Dan is the founder and CEO of Rio ESG, a leading ESG software solution and sustainability platform. I do believe you'll be seeing a short demo of Rio ESG after this session, so I won't say anything further or steal Dan and his team's thunder, but just to say we've been working with Dan and his colleagues over the past 4.5 years to support and help us kind of navigate the challenges, complexities and solutions around ESG data collection. Then on to Sylva Desalan, who is the ESG director at Stafford Capital Partners, an independent boutique investment firm focused on real assets and private markets. Sylva has a long history in the field of ESG, and is currently a member of the Principles of Responsible Investments Private Equity Advisory Committee, as well as Invest Europe's Responsible Investment Roundtable. And by no means last but not least is Carl Anderson, the founder and CEO of AVG Group, which manages the Nordic ESG and Impact Fund, SCSP, which focuses on investing in climate technology and climate infrastructure. So before I put some questions to the audience, to the panelists, I would just like to say that we would like to make this as interactive as possible in the short period of time we have. So please do send in your questions via the chat function, and I will do my best to put these to our fantastic panelists. So without further ado, I guess, you know, it's not news to anyone here and listening in that the data collection and disclosure of ESG information is very much at the top of the agenda. Dan, can I ask you, why do you think this is?
Hi, James. Hi, everyone. Sorry, I nearly forgot to unmute myself after all the prep we had. Yeah, so ESG data, I think that we could put that in the context of SFDR, right, as well, given what we're talking about today. I think ESG is front and center for a lot of people now, I think, because it's quite a new thing for us to start capturing. I think especially as the financial services sector at this level of kind of detail and granularity and all of the noise that exists around various frameworks and something like SFDR coming along, which is obviously going to mean we need to take a sharper look at data and information. But I kind of think, you know, those challenges you spoke about, James, earlier around SFDR, I think SFDR is a great concept. I think, but it's ultimately quite simple as a piece of legislation. I think the impact is for you guys as investors with lots of different assets. how you get that information, how you harness that information and move it along. And I think part of the issue is that there is a lot of overcomplication here between multiple frameworks, between software systems or platforms saying that they can capture thousands of ESG data points. The simplest way to look at ESG is through a materiality lens. What's applicable to me now and what's likely to impact me in the future or be an opportunity. So I think a lot of this is around us starting to understand the subject matter better and starting not just to be obsessed by disclosure, but just think what this data and this information drives. And in theory, by understanding environmental risk, social risk, or opportunities on either side, you will de-risk yourself for the future, but you'll also see opportunities that you might not have thought of before. So I think we generally look at this stuff as disclosure first, but the real opportunity is to understand the information that we have and move things along that way.
I think you touched on a really important point about materiality, and we might try and come back to that a little bit later on. Maybe if I just turn to you, Silva, and appreciate with a practitioner that is focused on ESG in their day-to-day activities, that has to live and breathe SFDR, the associated EU taxonomy, and all the other frameworks and guidance out there. How are you finding sort of dealing with all of this? Are we drowning in ESG data, and kind of what are the challenges that you've been dealing with?
Well, thank you, James, and thank you everyone who is attending this session. I don't think we're drowning in data. I think the fact that we're having discussions about data with respect to private equity, private markets is also a sign of maturity. So we're no longer just, talking about policies, and nowadays almost everybody has a dedicated person or consultant. So we've come quite a way, let's say, since 2006, where the first investor signed up to the PRI, to the principles. But we're not drowning in data yet, and different frameworks are helpful. They have different purposes. SFDR is really about disclosure. If you make specific claims regarding E or S characteristics, environmental, social characteristics, or sustainability as investment objective, then you need to provide certain additional disclosures. So that in essence is quite simple, and for the managers active in this space, for investors that have been doing that already over the years, I don't think it will present a lot of a challenge. I mean, maybe a temporary challenge in aligning the frameworks and adding some additional, let's say, data fields in their systems. But for the ones that are starting from scratch, it might look like a big challenge. Most of our challenges stem from the fact that we invest mostly indirectly through funds. So we are investing in timberland funds, in infrastructure funds, in private equity funds, farmland funds, and not just that, mostly in the secondary market. So which gives you a bit less, let's say, bargaining power in terms of, ESG related criteria or conditions that you would like to put inside letters, for example. So the fact that we don't have direct access to companies that have the data that we all need at the end of the day, because most of those templates, let's say the principal adverse impact in the SFDR, are company related data. So if you're far away from the companies, it's quite challenging to get all that data channeled to where it should be in those simple templates at the end of the day. So the fact that we're indirect investors, that does not help. I mean, that we're active in private markets doesn't help, because you cannot just buy data. I envy colleagues that are working at investment management firms that invest in listed companies, because they can buy almost anything from different providers. So we cannot just buy it, we have to go to the managers and ask for it if they don't provide it already. So engagement has been an important part of our work, engagement with the managers to provide more disclosures, to, if they don't do that yet, design their monitoring and reporting templates and provide data to us as well. Then for the managers that do report, there's a lot of data inconsistency. Well, I've heard today a couple of times in some earlier sessions, standardization, there's no standard. Well, there are different standards. There's SASB, there's GRI for corporate reporting, and we have principles and so on. But if I look at what we get from the managers in their sustainability reports, impact reports, ESG reports, different indicators for the same factors, different measurement units, different definitions, years without reporting, let's say, on the same metric for the same company. So we're not there yet there. And if you get to deal with the implementation of SFDR, well, we have a relatively large legacy portfolio. So for the legacy portfolios, we cannot really do much, right? Because we have not agreed with the managers that they would provide data that needs to go into PAI templates or anything else. So we can really only do that for, let's say, future products where we can agree with the managers. And of course, I expect most of the managers that will be offering their products in Europe will comply and will provide their data when they can, but we're not there yet. And maybe one of the most frustrating things are different templates from our clients, because we are on the receiving and on the giving side, right? We are asking our managers to provide more data and more disclosures. At the same time, we get requests from our clients that are global. Well, you probably know how those questionnaires and requests look like. So that doesn't help.
Sorry, yeah, maybe if I can just jump in here and actually say, I mean, I think some really interesting points there, and clearly this is where the likes of Rio and similar ESG solution providers come in, and I think we'll come back to a couple of the points that you flagged there shortly. If I may turn to you, Carl, as I guess an impact fund in Europe. You must be all over SFDR and the EU taxonomy. Can you just share some of your insights and experiences so far, and actually give us a flavour of, the solutions, the practical ways that you're dealing with this, and how you plan to deal with that ESG disclosure opportunity, as Dan calls it?
Yeah, thanks for inviting me to this, and thanks for all the other panelists and the like. Yeah, I mean, when I took a step back at this, we obviously had to come up with a process ourselves. And, how are we going to do that? Now, we benefit a little bit investing in climate technology. So we're already sort of in the E, kind of category. And also the Nordics happen to be very strong. We have something called HMS in the Nordics, which is health, security, and environment. So there's already sort of underlying our company's sort of a strength in reporting, if you will. But in terms of, thinking about this in a framework, I actually looked at it from a 50,000 point view and said, well, how is this going to matter to investors? What do they care about? And where is this going to ultimately end up 5 years from now, 10 years from now? And I firmly believe that this ends up in a credit score. So you have your credit scores now, but I think ESG will be a component to that. I just don't think that I actually hear about that from the marketplace. Also from insurance providers. So your premium will go up if you're not an ESG compliant company, or your lending rates might increase if you're not ESG compliant. So what does that mean? Because if I'm a lender and I'm an underwriter, how am I thinking about what's the criteria that I'm going to ask for in order to do an underwriting? So I thought, okay, well, there's that component. So how am I going to underwrite these companies? And actually, it was serendipitous. I was on another panel with Daniel, and after we clicked off, I was like, "Hey, you're a service provider?" He's like, "Yeah." So it's kind of a fireworks at first sight. But bottom line is, we think that these broader metrics, SASB, World Economic Forum, these are the big sort of general metrics that people are going to sort of rally around, and that's what we start seeing. We're seeing like people really start focusing on these major ones. So then we just have a process where we interview each one of the companies, and if we're going to marry it to some sort of financial statement or financial disclosure, it makes sense to add it to our financial NAV statements quarterly. So actually what we do is we go to the companies, we get baseline metrics. Wherever they end up is okay, because it's a starting point, and you'd be surprised, actually. Green companies think they're green, they kind of are, but you actually you get some interesting results from it. Anyways, so then we thought, okay, so build this report so investors can clearly see, from the company data, what it means to them. So in our statement, we actually created something where it's like, for every $1 million you put in, what does that mean? How much carbon was taken out of the atmosphere? So we have little diagrams, maybe Dan will show it to you later, but like trees, how many trees would have been planted? Or, because I think, again, what Silva was saying is there's too much complexity in this market. There's too many moving parts. So for investors, we're a fund manager. Our job is to simplify this for investors and sort of enable investors to get their head around it. So we simplified, a statement, but then the statement can also get as complex as needed. So we scored on World Economic Forum, SASB. And so then, an LP can say, okay, for my $1 million, now I see how they scored that. I can see the underlying companies. I understand how that process works. And then every year we have, KPMG sustainability check our work. So I think if you're a fund manager, marrying it to the process that you would have with any other service provider, your fund administrator, your auditor, and then have an ESG data provider is important. But I think finding the right provider that's cost effective is also important. Like to your point, James, we had talked to groups like, I hope they're not on the call. Oh, never mind, I won't name names. But charging anywhere from $20,000 to $75,000 per report per company, and it's like, all right, look, we're all trying to get to net zero. If we're going to do that, we have to have this cost effective. The data needs to be simplified. If our main goal is to do that, then things have to get more simple. We can't just sit around and legislate. I like the policy framework, but it's just a paragraph. But we can't have this interpreted into such complexities that the market's so confused. And I think with ESG, that's happened. And investors, when I talk to investors, obviously we try and raise money from investors, et cetera. They're super confused about what it means. And then they hear news articles, it's greenwashing, it's, all these sorts of things. And it really, once you can cut through all that and explain to them how simple it really is, and you marry it to a process, they're like, oh, that's all you were talking about. So I think it's important. Look, we come from the private equity world. So our mission is to talk to the companies and produce these reports, and then LP reports. And if you're a long short equity fund manager or commodities manager or something else, I haven't figured out or thought about, if you're in that space, how you might do that. I haven't thought about approaches, but certainly for PE or venture, I don't think it's as hard as people make it out to be. But anyways, that's.
Thanks, Carl, and maybe just picking up on something that you touched on as well, Silva, and you, Dan, around materiality, and obviously in a forum where you're investing, or in a world where you're investing in private companies where there is a lack of ESG data publicly available. How do you sort of deal with that challenge of materiality? Obviously, the SFDR framework, EU taxonomy is trying to be more prescriptive and provide all investors, fund managers, etc., with some clear kind of guidance and specific metrics to track. But in some cases, they might not be materially relevant to a business. And therefore, how do you approach that sort of practical practical point about, well, what is material, and you know, what should I be monitoring? Dad, maybe start with you on that.
Yeah, I think, yeah, you're right, and Carl said it as well. I think it's easier, isn't it, for certain types of investing than others. I think by the kind of private equity route, the kind of the company that you're investing into is, you know, has a function, doesn't it? It has a purpose, it has activities that make it up. And that's, you know, that's the way to lead your materiality. So, and I think this is, you know, the way ESG is kind of becoming sustainability, isn't it? I think those of us that, I come from a sustainability background, so I look at a business and a process from what's its environmental, social, and economic impact. Whereas you guys are investors and you think, well, that's if it's not going to make money, I'm not interested. Then I'll look at the environmental, social, and governance risks, right? Now we're moving to a position where that's embedded and integrated and they're the same thing. So when we look at materiality, we work with someone like Carl. We look at their assets, we look at the sectors they're in. Maybe they're photovoltaics, maybe they're wind, maybe they're fuel replacements, whatever they might be. Where are they based in the world? And we have to kind of have, you know, that we've got to use our brains initially. We've got to speak to the management team. We've got to understand how they operate. And then we've got to look at sector-specific guidance as well. If you just rely on SFDR, you will be ill prepared. SFDR is like Fisher-Price kind of metrics for reporting and disclosure. It's vague. It says things like just hazardous waste, report hazardous waste. Well, why just report hazardous waste? You know, it's things like that. There's no depth to it. And I find it really disappointing that there are amazing frameworks out there that have been produced by people like SASB, people like the World Economic Forum, and their core metrics, which, why the hell didn't they just align with that? Like, you know, why can't the regulators just play ball as well? So that, use those frameworks to guide your materiality, use sector-specific guidance to drive and help you understand what those risks are as well. And this is if you want to do it properly. And again, that comes back to the earlier questions around why are we doing this? And this is called the Sustainable Finance Disclosure Regulations. I get we need to be compliant. The driver is, if we're not compliant, we can't invest our money. I understand that. But don't think of it like that. That is so short-sighted. Think about it as the opportunity to better understand your assets, and their opportunities for improvement, their opportunities to be more resource efficient, their opportunities to build a better environment for us all. Because if we don't sort this out, none of you can invest anything, because the world could be dead. So you got to kind of put this into a bit of context, right? And I'm not a hippie. I'm not an activist at all like that. I'm a sustainability professional. But ultimately, you know, I think it comes back to that, James. I think materiality has to be, you can't just expect it to be simple in some ways. You got to do your homework.
And yeah, Silva, you mentioned earlier around you're a fund of fund typically investing in other managers where you don't necessarily have the ability to influence and or collect data from the underlying investee companies within those funds, and sort of linked to materiality that Dan has just talked about. How do you get around that? And do you find yourself becoming a nuisance to people asking for this information?
I don't think we're a nuisance. I hope we are sometimes a free consultant or help. At least we try to be that. But it is not up to us to assess the materiality or let's say the material ESG issues of the underlying companies, right? I mean, we have thousands of companies and assets. We cannot do that. We don't know. I mean, we don't have all the information that the managers have. So our focus are really the managers, and let's say, how do they assess what is material? What frameworks do they use? Do they have people that can actually do that assessment, and so on? So it's really working with the managers. And maybe a few comments on SFDR framework. I mean, regulation. I don't really see it as a reporting framework in the same way as, let's say, SASB or GRI for companies. It's really about disclosures of financial market participants that have certain products in the market offered to retail or institutional investors. And if you make specific claims, you need to provide more information. And I mean, there are a couple of templates in there which make it maybe look like a reporting template. So the principal adverse impacts template and the templates for pre-contractual and periodic disclosures for Article 8 and Article 9 funds. But if you look at those templates, I mean, it's still up to the financial product provider to decide, which metrics you're going to use to monitor, let's say, your as characteristics, or to what extent you are achieving your sustainable investment goals. It's not prescribed. What is prescribed is this, principal adverse impacts, which is, unfortunate because you cannot define material, factors for all the sectors and all the companies that will be in the financial products. And even though this SFDR brings like the concept of double materiality, right? I mean, you need to assess the impacts of the relevant, let's say, sustainability factors on your sustainability risks on your portfolio, on the value of your companies. But at the same time, you need to assess the potential negative impacts of your investments on, let's say, society and environment. And for that purpose, they have introduced this PAI template, which, I think will be the most challenging part of this, of the whole implementation, at least for us, because I cannot aggregate the numbers for all the underlying managers, especially, for a lot of them, I will not have the coverage for a couple of years, probably not, or they will opt out because they will not have the data yet. But it's, it's kind of funny in a way, because on the one hand, you still need to decide what is material, which risks. You decide as, let's say, fund manager that has a fund there, how you're going to monitor, but you have to use this template with the negative impacts, which might be completely immaterial to your businesses, but you still have to report on them.
Thanks, Silva, and Carl. I mean, a lot of really useful insights and points Silva's sharing there around the implementation and the practical, I guess, aspects of trying to implement SFDR. We haven't mentioned too much about the EU taxonomy, which is kind of this then other framework sort of around the SFDR and beyond, that I think is very much focused on sort of more pure play sustainable investments, investing in, renewable energy, environmental solutions, and so on. And given the impact fund that you're representative of, has the EU taxonomy sort of come across your desk as well as part of this SFDR implementation as well? And if it has, can you just elaborate on what it is and how you're dealing with it?
Yeah, well, let me just comment a little bit about what Silva said, because I think it's important when you're dealing with the companies how you get that material, and then I'll sort of explain why I'm leading with that. You have to explain it to the companies when you're like, all right, listen, we're gonna lift up the cover of your book and we're gonna go through your company and we're gonna discover your ESG score and we're gonna base it on A, B, C, and D. Now, the way I talk to the companies about that is the following. If you were a hot dog stand owner and you complied with an ESG policy, or a hot dog stand owner that didn't, and you were about to sell your business to a big market, who's going to have the higher cost? Who's going to get acquired for more? Well, the guys who have the ESG policy. And what I'm saying is a lot of these companies don't realize that this is a huge marketing tool, that if they score well with their ESG policy, and if they're going public, because I see that oftentimes in the Nordics, you have like Euronext, where they're going to go list. If you've been saying, this is my ESG policy, this is how we're scored, this is all the good stuff we've been doing, people are going to pay a premium for it. So it is monetarily going to benefit you. And here's the other interesting thing, as for renewable energy, as we went through it and looked at financial statements and their business models, et cetera, we realized that, and this follows in Kyoto Protocol and all the other sort of protocols, that these guys were producing carbon credits or, renewable energy certificates. And that wasn't priced in at all. And they didn't know how to originate or, monetize basically their portfolio. So we got that out of, our ESG reports. So we unearthed a lot of financial gain for the renewable energy companies, and especially in infrastructure who didn't have purchasers, didn't have offtake agreements to buy the carbon credits. So that can significantly increase the profitability of the companies. And, so in terms of, ETS or some sort of, scheme, you have to underwrite to wherever the jurisdiction is, wherever the, company is actually producing the renewable energy. So it does become kind of specific, and, we've had to learn how to do that. And that's still something that has somewhat of a question mark over it, like in each doing the origination of carbon credits, depending on jurisdiction, depending on the protocol. Is it a bilateral contract that you enter into with an oil major? What governs that? What's the quality of that carbon credit? How does it carry on? Can you get sued for doing the origination and it's a bad contract? So you have to wrestle with all of these and verify them in each jurisdiction. So it's, so we're still, wrestling with some of that. But what we do know is that the price of carbon has gone from, $3 to $60. So we know that it's worth pursuing, and that there's a lot of business models that can, come from that. So to Silva's point, I think to encourage the fund managers, just remind them that their underlying portfolio companies will earn more money if they have a stronger or more robust system for measuring their ESG metrics. And I think that's full stop. But
and I think, correct me if I'm wrong, but in there you're sort of also implying that do your ESG due diligence well, and also do it in a way that's not just about risk management, but is sort of forward looking and focusing on the opportunities that ESG presents. And obviously you've untapped some additional value through those businesses that you alluded to, and the additional revenue streams from the credits, etc. I guess just coming back to my question on the EU taxonomy, has that fact featured at all in your sort of compliance and monitoring and sort of, I guess, the conversations you've been having with Dan and other software providers?
Yeah, we could field that if you want, Carl.
Yeah, sure. Yeah.
I think for a company like, for an investor like AVG, where the core business is one of purpose, right, is to remove carbon from the atmosphere, to create more circular economies, to look at materials in a different way. It's actually really easy the taxonomy becomes more challenging when you've not got a genuine purpose, I believe, or you're skirting around the edges. And I've seen this a lot from the SFDR side as well, where big funds and fund of funds are kind of coming to us and saying, we've got 100 million that we're putting into an SRI fund or an impact fund. And then you say, okay, brilliant. What's the impact you're having? We haven't worked that out yet. That's the most cynical thing, if you think about it, because the whole point of this is that you do, and I think the taxonomy helps that. I think it gives themes for investment, doesn't it, as well? So with kind of like with an impact investor or an SRI investor, this stuff isn't really a challenge, and that goes back to Silva's earliest points at the start. If you're already doing stuff, if you've already got a strong management system in place around ESG and sustainability, none of these things should really cause you too much concern at this point, because they're for the people that haven't done it yet. It's trying to encourage a market that's learning in the massive sense how to do this stuff. So I kind of think of it like financial reporting and accounting. And if you said to me, like, just kind of, give me a management accounts, and I haven't got any system or management system or financial reporting system to help me, I could probably do it, but it costs me a fortune and it might not be very good, right? It's just these things are things that we manage that have strong processes and regulation behind them. This is such a juvenile area for this stuff. So I think why wait for the laws and regulation? Why wait for those politicians at COP to put more stringent measures in place? Just get ahead of it. Because as Carl said, you'll unearth things that are actually pretty significant financial opportunities in many cases. or you'll find ways to help a company save money and be more profitable, or move into different avenues, you know?
And do you think putting an ESG score on a business is going to help drive this?
Yeah, if the score methodology is clear and transparent, you know, I think that's the criticism, isn't it? That you can get a score. Here's your score, James. It's 25. Right, great. Thanks very much for my 25. But what the hell does that mean? And where's the substance behind it? And how have you calculated that? And is the information verified? So if the scoring system is verifiable, clear audit trail behind it, yeah, it's only going to help. And then that dovetails into Carl's point around credit ratings, credit scores. It's going to go that way, isn't it? This is just inevitable. And then the things that we have to do in the UK on our kind of annual returns, it's going to say to me, what's your carbon footprint been this year, Dan? What's your D&I statistics? It's inevitable. When, not if, right? So just get ahead of it. So I'm probably concluding, aren't I here? But that's kind of, I hope that links to your answer and answers to your question anyway.
And James, if I may add a few comments on the taxonomy. While SFDR is about disclosures and it's relatively simple, if you read the text, it's quite simple. It's just that, yeah, I mean, the complexity lies in the implementation by different types of, let's say, investors and for different products. The taxonomy, on the other hand, is a classification system, right? And I find that much more complex. Because, I mean, it's a classification system where you define what is sustainable, let's say what is sustainable in, or what are sustainable activities in the EU. And at the moment, we only cover two elements of environmental sustainability, and we already have, they have more than 200 pages of technical screening criteria for that. There will be, I don't know how many 100 pages for the remaining 4 environmental objectives. And we don't have the classification of what is socially sustainable yet. So, and EU taxonomy is one out of, I don't know how many, I saw some number, 16 taxonomies in place and in the working. I mean, this is complexity, and the way it touches upon, or the way it's related to the SFDR is, so if you claim to have a fund with sustainability as an objective, so an impact fund, or if you make some impactful investments, then you will have to report in the future on the alignment of your investments with the taxonomy. So it seems like one simple, at the end, it will be one simple number. It will be a percentage in the template. But to get to that, I think there'll be a lot of work for consultants and lawyers, mostly consultants, to help assess the alignment, because you need to go really down to the company specific data, know the activities, where the revenues are coming from, and see to what extent those revenues are aligned with the technical screening criteria and some other criteria. So I see that really as such a complex piece, and given that we're not dealing or investing directly in companies, I'm really, well, I'm happy, to be honest, that I don't have to deal with that. But I'm curious to see how that will be implemented by the managers that we're working with. I believe there was some assessment by the I don't know, commission or somebody on their behalf did some survey of, I think, about 500 companies, large European companies, to look at their alignment with the taxonomy. And I think they came out to 4 to 8% or something like that, you know. Anyway, so I think that part is quite complex. And I hope that at the end it will help investors, you know, distinguish between, let's say, I don't know, you cannot even say more sustainable or less sustainable funds, because you need to know what that number captures, right? If it only captures climate change mitigation and adaptation, and you're a fund focused on, let's say, social impact, yeah, that 0% doesn't say anything at the moment. So I'm curious to see how that will help at the end.
And I guess a question to all of you. Let's say I'm starting out on this journey, this ESG journey and data collection specifically and are very new to it, where can I go to get some good practical guidance and toolkits? Are there any you can share with us and the audience?
Should I start? I'll just mention a few. Well, I have conversations with managers that, well, by now they have a policy. They would have a policy. We have some very best practices that have, impact-weighted accounts for their companies, but we have the ones that have very little. Anyway, so what we direct them to is typically publicly available tools, right? And we have initiatives such as the Principles for Responsible Investment. They have really active work streams, for example, on private equity, on many other asset classes, where you get guidance as an LP or as a GP. Other industry organizations, Invest Europe, guides again on ESG questionnaires for companies. So at least to give you some guidance of the type of questions you should be asking. So I would say check PRI, check the industry associations, because there's a lot out there. And on specific topics like climate, TCFD, all the tools are public. Invest Europe has a climate change guide for the members. So I would start there. Initiatives, investor initiatives, and associations.
Yeah, I'd agree with that. I think there's some really good stuff there. And I think things like SASB and organizations like CDP who've been doing this stuff a very long time, there's always things to find there. We've actually launched a how to capture ESG data guide today as well, that's targeted at kind of investors, but also their assets. So, and we do lots of guides like this that just try and make it all a lot more simple and really simplify a lot of these very technical things, like, what's an ESG rating and what are the disclosure frameworks. So we just done a guide today.
How can we access that, Dan?
I should know that, should I? I imagine there's some kind of downloadable link that we can share, or the organisers can share with the delegates to obtain that. It's great. It's free and it's from our website. Yeah, otherwise you'll find it on rio.ai, I'd imagine. So I think that's good. And but there's just so much content out there otherwise, isn't there, just to kind of plot your way through it all.
Yeah, and maybe if Carl, tell us how to unlock the value from ESG, as you're the master.
It's a secret. Now, no, honestly, I'm more of a practitioner in the sense that I kind of avoid some of the big narrative type groups who just do this macro. I end up calling service providers or lawyers who've had a client who got in trouble over it, because you find out a lot as to what you're supposed to be doing and what you're not supposed to be doing on a practical level. And, service providers are great because if you talk to 3 different, groups, sometimes you get smarter and smarter with each service provider you talk to. And you can tell which ones are trying to, just sell you a service, and then ones that are trying to actually help you. And some have some of the pieces and they don't have the full piece. So I think it's honestly, it's a kind of a smile and dial kind of practitioner. Just Google search a million different types of service providers, see what they say, and don't just focus on Europe. Call some in the US, call some, in Singapore, find different people and what is important to them. And you'll kind of start getting a gist of what you kind of need to do. And then I think it's just important then have an internal meeting and come up with your own process, because that's ultimately what we had to do. And just from a reasonable point of view and talking to investors, what do they want? What are they going to want to see? And have an active dialogue with LPs. Because again, it's complicated. Our job as fund managers is to make it simple so that there's not more questions asked by regulators, that there's not more questions asked by, you have to obviously do your homework. But, this is why I work closely with Dan, because we actually, we're troubleshooting some of the, front lines of this stuff. Like, what should we do? What is the next step? What are LPs asking for? And we discover stuff all the time and different trends coming from the companies. So I think it's, these are still very early days in the process. I think it's just important to put together a process, and however wonky it is at the beginning, it will tighten up over time. And just, but I think it's, it's constantly evolving. And I think Dan's right. If you can get in touch with groups like SASB, World Economic Forum, North Pole, some of these other groups, you'll find out quickly. But I would say even, try and get free information from lawyers who've been through this route, who have clients. In fact, we did that with sort of the carbon credit stuff. I just talked with attorneys who had clients who had to represent the contracts. And okay, what did you guys do? And they obviously want you as a client, so you can get a lot of free information from them. But it's just a practical way of doing it, I guess, from a street smarts way of thinking about it.
Well, I've just been notified that we have 5 more minutes left. So now's the chance for any questions from the audience. Please do ping those in if you can. I guess at the moment we don't have any questions.
Can I ask you a question, James?
You can.
I
might not answer it.
Yeah, you reserve the right to not.
Yeah.
But you kind of like me have come at working in ESG via working in sustainability consulting, like haven't you? Starting kind of from an environmental due diligence and actually going to sites, visiting sites, understanding risks. Do you think that's an advantage? Because we're looking about how do you understand this stuff, and I find one of the things when you talk to Big Four or others is they're very superficial because they don't know how these things look on the ground level. So my argument is that if you go for a sustainability professional or a sustainability view, you're going to get a more rounded understanding of what the risks are, because these are people that have been to contaminated land sites or landfill sites or stuff around the world where this stuff actually happens, versus an analyst in a room just looking at data points with no context. So I was going to ask you what you felt from your perspective as the most effective way to look at that.
Yeah, that's a great question, and thanks for putting me on the spot. No, look, I think obviously having that opportunity to go to companies and engage and collaborate with management teams at that level, and to understand the ESG topics at the coal face, so to speak, has certainly been advantageous, and I think is something that I've brought along with me throughout my career in how we engage and collaborate with companies. And it's actually trying to, we go in with all these loaded questions, frameworks, compliance, but actually you also need to put yourself in their shoes on the receiving end. So I think, having had that ability to be at the sites and look at these issues in real life, so to speak, has been important. But even if you haven't done that, I think just being proactive, collaborative, and sort of engaging with management teams, understand their business, try and be pragmatic. Well, certainly we have tried and looked to be as pragmatic and flexible as possible, has really been advantageous to, embedding ESG into our investment and ownership practices. So yeah, hopefully that answers your question.
And James, if I may add something to that, an additional question. Do you see different responses from companies in different sectors and in different regions? Because we know that, different sectors have different exposures to climate and some other risks that are high on the agenda.
Yeah, and I could probably talk for days, weeks, months, and years on this, and we have 2 minutes left. So, okay. In short, I think absolutely we do see different levels of responses, understanding, resources to ESG and monitoring across different sectors, as well as across different sizes of businesses. We invest across various different sectors in different sized businesses, and that has an impact on the level of understanding and the ability to apply a framework. But for us, it all comes back to materiality, being focused, working on what is going to enhance the business going forward and create additional value, like some of those examples that we've talked about earlier. So yeah, that's kind of how we see it. And I've taken a lot of notes, and I wanted to try and conclude, and I really don't think there is a short way to conclude on all of the great points and discussion points that we've just heard about. I think it's clear there's still a lot to do. Materiality is important, and that time's running out, and we just need to get on and work towards net zero. So I will thank the panelists again for your time, and also the audience for listening in. I hope that was a useful oversight into the ESG data world and opportunities. And as a reminder, you'll now be in a short presentation from Rio and the team on their ESG platform. So thank you very much.
Thank you. Bye-bye.
Thanks.